Here's why you shouldn't invest in Tesla. Are you a stock investor who is totally smitten with Tesla shares? Have you answered yes? Then you should stop right now. We know it comes as a shock that you are willing to put your money at risk, but what we are saying right now isn't made up. We're going to present some factual data before you that will open your eyes and help you understand the whole matter. But you'll need to stick around with Trend Capital for the next few minutes. And before we begin, make sure you please subscribe to our channel. Okay, you ready? Let's get started. Among the most intriguing publicly traded companies in the world is Tesla Motors, Inc., which has been labeled by many as a high-risk, high-reward stock. Elon Musk, Tesla's founder, is a controversial tech superstar, and the company's Silicon Valley roots have raised the bar for investors. In 2021, when it became the only company in the world to have a market cap of $1 trillion, Tesla became even more of a media darling. The trajectory of Tesla's future is intriguing, but it's still hard to pin down. The big question is whether or not Tesla is a good investment and a long-term winner. Well, we would argue it isn't because of its price tag, the strides its rivals are making, the lack of real earnings at the company, the absence of a coherent long-term strategy, and the shoddy management at the top. Risk number one, Tesla cars continue to be overpriced. Even with generous government incentives, such as tax breaks for alternative technology, potential buyers of Tesla's Model S are still confronted with a high price tag, which, as of November 2021, starts at $94,990 before any incentives or discounts. This price tag is despite the fact that the government offers tax breaks for alternative technology. Even Tesla's newest, more affordable option, the Model 3, will set you back $43,990 in May 2021, and that's before you factor in any tax breaks or savings on gas. This puts it well out of reach for the majority of motorists. Not only are the vehicles pricey for buyers to acquire, but Tesla also loses money on each one it manufactures and sells. According to the estimations of Vertical Group analyst Gordon Johnson, the company lost approximately $14,000 on each Model 3 vehicle that it sold in 2018, although these figures may improve as the company scales up. Risk number two, Tesla's batteries could run out. One of the first issues Tesla executives faced was a scarcity of batteries to power their products. Tesla's Gigafactory, which is still under construction in Sparks, Nevada, is expected to solve the company's battery crisis. The lithium-ion manufacturing plant, with a planned footprint of more than 1.9 million square feet, is expected to contribute to the annual production of more than 500,000 Tesla vehicles. Major projects such as the Gigafactory are frequently hampered by logistical or regulatory challenges, and it remains to be seen whether the factory will be completed on time. The Nevada government has approved the Gigafactory, which is expected to generate $100 billion in additional economic activity over the next several decades. Although the facility is only 30% completed, Musk has hinted that one Gigafactory may not be enough to meet demand, and the company may require several such facilities. It will take a massive amount of capital expenditures, or CapEx, to keep the company fully charged and shareholders satisfied. Tesla was the leading manufacturer of plug-in electric vehicles in the first half of 2021, accounting for 14.55% of all global sales. With 12.52%, VW Group was the next largest manufacturer. Risk number three, reduced cost of gasoline. The decline in the price of gasoline that occurred in 2014 and 2015 caused Tesla to lose some of its sparkles. Considering that gasoline-powered cars are Tesla's main competitor, and given that gas prices have been going down, the economic case for gasoline-powered cars have been strengthened. It is not necessary for gas prices to remain at decade-low levels for Tesla stock prices to be negatively impacted. Rather, gas prices need only to be low enough to encourage drivers to keep their older vehicles on the road. The gas predicament that Tesla is facing originates from two different directions at once. The first issue is an increase in oil production around the world. The peak oil theory, which was once widely accepted, appears to have been disproved, as annual increases in global oil production have been observed from 2009 through 2019. Oil companies are becoming more proficient at locating new oil deposits, and with the assistance of hydraulic fracturing and horizontal drilling, they are also becoming more efficient at extracting oil from existing deposits. At the same time that there is an increase in the amount of available petroleum, improvements in the efficiency of internal combustion engines have been made. The Bureau of Transportation Statistics reports that the average fuel efficiency of light-duty passenger cars in the United States is continuing to improve. In order for Tesla to make the transition into a mainstream auto manufacturer and generate stable cash flow, the company needs to sell a significant number of additional automobiles. If gasoline and other fuels derived from petroleum continue to be significantly less expensive than other options, then consumers are less likely to switch to electric vehicles. Risk number 4, an increase in the number of other electric vehicles. There have been other companies that have developed electric vehicles before Tesla. Interestingly, Thomas Davenport's credited with inventing the first electric automobile around the year 1834, but so far Nikola Tesla has been the most successful inventor in this field. Both the Chevrolet Bolt and the Nissan Leaf, two notable competitors, were unable to gain early traction due to the high retail prices and the limited driving range of their vehicles. As of October 2021, the Nissan Leaf will have a range of up to 226 miles and a starting price of $27,400 before any applicable incentives. In October of 2021, the standard model of Tesla's Model 3 will have a range of 220 miles. The Chevrolet Bolt, with a range of 259 miles and a starting price of $31,000, will have a range greater than this. 12 additional manufacturers intend to enter the market for electric vehicles within the next few years. These manufacturers include Mercedes-Benz, Volkswagen, Subaru, Ford, and BMW. In the event that this occurs, Tesla's market share may begin to become more competitive. Apple Inc. believes it can compete with Tesla in the transportation industry, and Google has also placed bets on the auto industry. Other technology companies may also enter the fray at some point. It's no secret that Tesla is concerned about competing companies that already have larger consumer bases. Risk number 5, it is possible that Tesla will never recoup its massive expenses. Musk is famously credited with having said the following about his company at one point: "We are going to spend staggering amounts of money on CapEx." There is a large number of investors who enjoy seeing high levels of capital expenditures. However, there must be a payoff on the other end. This seems to be especially true in a young industry that's littered with businesses that have failed to launch. Tesla's already spent billions of dollars on the development of the Model 3 and the Model X automobiles. Additionally, the battery factory comes with its own significant cost. In a filing with the SEC for the first quarter of 2021, Tesla estimated that its annual capital expenditures would probably increase to $4.5 or even $6 billion by that point. Risk number 6, a contentious part-time CEO. The same quarterly report mentioned Tesla's reliance on Elon Musk. Tesla is highly dependent on the services of Elon Musk, Tesla's techno king and our chief executive officer, according to the company. This is not particularly surprising, particularly in the technology sector. Consider Steve Jobs and Apple. What comes next is perhaps more concerning. He does not devote his full time and attention to Tesla. Musk is an extremely active executive. Before joining Tesla, he was the CEO of PayPal, and he's now the CEO and Chief Technical Officer of Space Exploration Technologies. He's also the chairman of Solar City, a company that installs expensive solar equipment. The departure of a key executive could be a significant setback for the company. Furthermore, as one might expect from a self-proclaimed techno king, the eccentric CEO has become a lightning rod for scandal. According to the same quarterly filing, Tesla and Musk are now the subjects of 9 pending class action lawsuits stemming from a 2018 tweet in which Musk falsely announced plans to take the company private. The tweet's accused of attempting to manipulate the share price of Tesla, a violation of federal security laws. So we think it's time to use your head and take the decision on your own. Now you decide whether you have put your money in Tesla stock again or whether you should withdraw. The choice is yours. We've provided you with this relevant data. And that'll end today's episode. Please keep in mind the purpose of this channel is not to give financial advice, and we do not recommend or encourage you to invest in any particular firm. This is how educational interactions brought right to your front door for your convenience. In light of this, we strongly suggest you perform an extensive study on the subject before making any purchases related to it. Thanks for watching today's video, and we'll see you next time.